Hi there, and welcome to a masterclass in getting the right mortgage. This is part two, the ratios you need to know. In part one, we discussed employment verification, income verification, down payment, closing costs, and the do's and don'ts after you get pre-approved. So if you have any questions about those, please go and find part one. Part two, we're going to be discussing ratios. So GDS and TDS ratios and loan to value ratios. So again, I'm Steve Lang and I'm a dual licensed mortgage and insurance specialist. I can help you get the right mortgage and then put the protection in place to make sure your loved ones are taken care of should anything happen to you. I work in association with Castle Mortgage Group and Castle Insurance here in Winnipeg. We have such a great group, 40 mortgage specialists in Manitoba and surrounding areas. We have a fantastic relationship with all our lenders and underwriters. It makes such a huge difference in what I'm able to offer my clients. So we were talking about the 10 steps to getting a house. So what can I do to offer you a Disney experience here in Manitoba? So today, again, we're still talking about the first stage, the pre-approval. In the part one, we talked about down payment, deposit, and closing costs. Today, we're still talking about the application. So the numbers behind the application. So mortgage ratios. So key part of capacity, which I'll talk about in part three, to pay is based on the relationship between the borrower's income and the loan being sought. So the analysis of debt service ratios allow a lender to see whether or not a borrower can afford a mortgage loan. In order to provide some protection against default, lenders will generally restrict the mortgage loan so that no more than a specified portion of the borrower's qualifying gross income will be allocated to the repayment of the mortgage debt. So debt service ratios compares borrower's debt to their income. Now, two ratios that check to see if a borrower has enough income to pay off their debt. First one is gross debt service ratio, or GDS. So it includes all of the debts that are associated with housing. Now, TDS, total debt service ratio, includes all the debts that are associated with housing, GDS, plus any other loans that an individual may have, such as credit card payments or car payments. So gross debt service ratio. Gross debt service ratio is a percentage of the annual qualified income. Now, annual qualified income we talked about in part one. So go and have a look at that if you didn't. It is required to handle all of the payments that are associated with a house. So the payments that are associated with a house include principal payments, interest, property tax, heat, and now if you are buying a condominium, half of the condo fees are applicable. So these four costs are often referred to as PITH, or principal, interest, tax, and heat. The calculation for GDS is PITH plus half the condo fees, if applicable, over your total gross qualifying income. Now, gross qualifying income is your before tax income, right? So if you're making $120,000 a year, we take $10,000 a month, okay? Generally, lenders today use a ratio of 39-44 if the FICO score is over 680. So these ratios are generally set by the insurer, such as CMHC or Sagan. The 39 number represents the GDS component. So in other words, a borrower can only spend 39% of their gross income for PITH. So now we have an example. Susan wants to purchase a home with a monthly mortgage payment of $1,100 a month. Taxes are $100 a month and heating costs are $75 a month. Her income is $4,500 per month pre-tax. So using GDS to decide, does Susan qualify for a mortgage? Well, the numbers P and I is 1,100, T is 100, and H, heat, is 75. So you put all those numbers together and you have $1,275 a month. So you put that over top of $4,500 a month, you get a percentage of 28.33. Now, 28.33% is below 39%. So Susan would be able to qualify for the mortgage on the GDS side of it. Now, I know it's not terribly exciting, but it's something that you've got to learn. Total debt service ratios are the percentage of annual qualified income required to handle all the payments that are associated with the house, plus all the other payments to service your non-mortgage debt. So this includes bank loans, credit card payments, car payments, any alimony or child support. So the calculation is PITH plus, again, half the condo, plus all your other monthly debt payments over your total gross qualifying income. Items such as home insurance, life insurance, car insurance, all those ones generally don't get included in your TDS calculation, because usually if you miss a life insurance payment or a car insurance payment, they just cancel the insurance on you. So it's not one of those things that needs to go into the TDS payment. So again, lenders use a ratio of 39-44 if your FICO score is over 680. The 44 in this case represents the TDS component. In other words, a borrower can only spend 44% of their gross income for PITH plus all other debts. So again, let's go back to Susan. Susan wants the house. Her mortgage payments are $1,100 a month. Taxes are $100 a month. Heating costs are $75 a month. Her monthly income is $4,500 per month. Now, Susan also has credit card debt of $250 a month and a car payment of $400 a month. So using the TDS, does Susan qualify for a mortgage? Well, we have to use everything in the PITH plus credit card plus auto, put it in the calculation, and that comes out now at a monthly mortgage payment or a monthly debt payment of $1,925 over her monthly income of $4,500. So that gives us a ratio of 42.77. Now, because the TDS is below 44, Susan would be able to qualify for a mortgage on the TDS side. So now, what happens if we had that line of credit for $200 a month? Well, if we had the line of credit for $200 a month, we have to add it on top of our PITH, our credit card, our auto, and our line of credit. So now all of a sudden it's $2,125 a month for her monthly mortgage payment obligations. $4,500 income still, and now look at the number, $4,722. So TDS is above 44, so Susan wouldn't be able to qualify for the mortgage just for the TDS side. So it just shows you what that extra $200 per month can cause in the ratios. So now, what can we do for Susan? Well, either we find her more income, maybe we get somebody else on the loan, or we find more of a down payment. Maybe grandma again is going to give her that down payment a little bit more, or she finds a less expensive home. Okay, almost there. Loan to value ratio, LTV. So remember in part one, we were talking about the 5% down payment required on any mortgage. So this is where it comes into play. Lenders want you to have some skin in the game, so to speak. So they're concerned that if they have to take the property back due to a default payment, they won't lose money on the sale of a house. Now, the maximum mortgage amount is determined by taking a maximum percentage of the lending value of the property. Now, the lending value of the property is defined as its selling price or the appraised value of the property, whichever is lower. So loan to value calculation is mortgage loan amount over property lending value. Now, we have Leanne. Leanne wishes to purchase a home for $230,000. She has a $50,000 down payment, so she requires a mortgage of $180,000. So what is the loan to value for Leanne here? Mortgage loan amount over property lending value. So you have $180,000 over $230,000. That gives us a percentage of 78.26%. So the loan to value is below 95%. So Leanne would be able to qualify for the mortgage. Now, that's not the TDS and GDS ratios. This is just strictly loan to value ratios. Now, that's the end of part two. If you have any questions, please go to my website and book a time for us to talk about your mortgage, and or give me a call. And look out for part three, and hope to see you soon.